Hello everyone. Following the capture of Venezuela's Maduro on the 3rd of January, many expected the US to jump on the opportunity to take their oil. They were successful in seizing tankers leaving from the ports of Venezuela. These assets would, according to Trump, pay for the operation. The media has since then portrayed a picture of the US coming to get Venezuelan oil, especially pointing out that they have the largest reserves in the world. In today's video, I want to give my thoughts on why I don't believe this will happen. Despite the US government's narrative, US companies like Chevron, which is already operating in the country despite the sanctions, seem very reluctant to invest. We're going to start off looking at the Orinoco Belt. This is the largest reserve in the world that everybody's been talking about. It is 80% of Venezuela's oil reserves and 70% of Venezuela's daily oil production. It mainly consists of extra heavy oil and high sulfur content oil. So these are two problems with this oil. So extra heavy oil consists mainly 60 to 70% of residuum or bitumen, and the high sulfur content due to a law imposed IMO 2020, fuel oil is not allowed to have higher than 0.5% sulfur. Both of these can be circumvented either by hydrocracking to reduce the bitumen into smaller hydrocarbons or hydrodesulfurization. However, both of these will cost extra money and make the processing more complicated. I do want to talk about the Athabasca oil sands today. This is a big oil field over in Canada. And the reason I'm going to be talking about it is because it is very similar to the Orinoco Belt. Both of them have a similar API gravity, which is how easily the oil floats in water, and therefore a big part of how easily it can be transported. They both have high sulfur, and they're the first and second largest reservoir. I'm going to be talking about the viscosity in a moment. How is oil mined in Athabasca? If it is above 75 meters, generally mining would be used. If reserves are below 75 meters, they would use SAGD or thermal in situ. A majority of the Orinoco Belt reserves are 200 meters deep, therefore mining is not viable. This is a picture of the oil found in the Athabasca oil sands. It does not look like oil. It is too viscous to transport in a pipeline, and it would need to be below 350 CP to be able to transport it. Looking at the viscosity and the general well temperature, both of them seem to not satisfy this demand. Two ways that this can be circumvented is either dilbit or SCO. Dilbit, standing for diluted bitumen, is generally the cheaper and lower quality way of getting around it. It is essentially just a blend of the bitumen and of condensate, usually naphtha or any shorter hydrocarbon chain. The result is a larger API, which allows it to flow easier in pipelines, but it remains the same sulfur content. SCO is essentially just putting it in a distillation tower, upgrading the bitumen into the parts that are more desired. The result can be a higher API, and hydrodesulfurization can be included in this step. SCO is very capital intensive and higher quality. Venezuela's infrastructure has historically not chosen this and preferred the cheaper, easier to do dilbit option. Some oils are more equal than others. Not every oil is the same thing. It has a different consistency and therefore also demands a different price on the open markets. Looking at the Athabascan oil, Western Canadian Select, we see a $12 difference between the US shale oil and the Western Athabasca oil. Now over to Mary 16, which is the oil produced by the Orinoco Belt, we see it is very similar to the Canadian oil. Similar gravity, similar density, and quite similar sulfur. So it would not be a stretch to assume that the price of WCS and Mary 16 would be more or less similar. Up next, I want to look at some average costs of running oil fields and oil mines over in Athabasca. Operating costs are generally around $10 to $20. Half cycle, which includes sustaining capital to keep the machines running and diluent, would be around $25 to $35. full break even, including every cost such as the previous plus royalties to the Canadian government and general corporate costs of running the company, would be around $40 to $45. Given an oil price of $50, it would still be economical to run the current fields. However, if in the case of new projects, there is the additional new build capex and financing for that money, the range of cost around $55 to $75 would not be economical given an oil price of 50. So most companies would be very happy to continue running their current wells, but would be unwilling to invest in new ones. On top of that, there is probably a change in technology required for Venezuela. Venezuela generally uses this CHOP method for a 10% oil recovery, as opposed to Canada's SAGD, 50% oil recovery. Keep in mind, oil recovery does not equate to efficiency. It is just the amount of oil that is recovered from the well, but it gives a good picture of how the wells are treated. So this requires higher upfront capex, which Venezuela does not have the know-how for, and Chevron is probably just not willing to invest this. Now, even with that, improving still takes a long amount of time. It took Canada about 7-8 years to drop their all-in costs from $76 to $49, making it today one of the profitable players in the oil game. So even if Venezuela were to reach Canadian efficiency, it probably still will not be profitable in due time, as it would take a long time for them to actually reach the same point that Canada is. So up next, I want to talk a bit about whether Maduro was the real reason for Venezuela's decline. This is a chart mainly found, it is the first one found in Wikipedia, and it just shows the revenue of barrels of oil over time. Over here we see Maduro coming in on 2013, and immediately the price of oil dropping down. However, I'd want to say that that's probably just because of the price of oil dropping in 2014, mostly due to US going in very hard on shale oil. If we were to look at the actual barrels of oil, we don't actually see a big impact from Maduro coming in. What we do see, though, is a big decline around 2017, which is the year the US imposed economic sanctions, and subsequently the inflation in Venezuela skyrocketed. So one of the nicest ways to look at why these sanctions are so prohibitive, we're going to look at diluent import. So dilbit, mentioned before, is where you dilute the bitumen with some other smaller hydrocarbon. In Canada, 67% of that diluent is domestic and is just transferred over. The other 33% coming from the US. So in Venezuela, they don't have the capacity within the country to produce this diluent. Therefore, generally, historically, import 100% of it from the US, usually around the Gulf area. So due to that being very close, it would generally only cost $4 per barrel, which is a very good price. However, Venezuela under sanctions would be forced to import this diluent from China, Russia, or Iran at a much higher cost, around $15 per barrel. And that, on top of that, there is the uncertainty and the high insurance risk premium to pay to get this diluent. So Venezuela's oil under sanctions, I don't believe would ever be economical. So despite all the things I've talked about today, the US government is still trying to sweeten the deal for players to enter in the market. The historical 30% royalty put in by Chavez, there is theories that it will be reduced to 20 or 15% if a deposit or a project will not be economically viable with the current 30%. Other sources say it will be reduced to 0. So that is something that we will remain to see yet. So here are some attempts of the US basically hijacking already mined oil and trying to sell it to US refiners around the Gulf area. They tried to sell it around $6 to $7 below Brent per barrel it looks like at that price, refiners weren't quite willing to switch over from Canadian crude, as both of them have similar quality, but Canadian seem to be at a lower price. So there's many people making theories of how much money would have to be invested, but here is a source saying $50 billion just to keep up current production, and $150 billion to reach 1990s level of oil production for Venezuela. That is a lot of money. I've put here a chart of the general capex by big oil players annually. So it would take many years of a lot of investment for these companies to reach this level of production, and I don't think they would be willing to do this under the current environment and given all things I've talked about today. So to finish off, Venezuelan oil is very heavy and sour and difficult to process. The price discount for this extra heavy oil will be hard to justify investing in. And I think as long as oil is below $70 per barrel, I really don't see any company willing to invest meaningfully. I hope you enjoyed today's video. Hope to see you around.